Hello, welcome to lecture 21, where we're going to talk about time frames. So we know that price patterns occur on all time frames, that the markets are fractal in nature. And so we have to focus on a few specific ones, though, when it comes to an investing and trading process. It's best to usually master one or two of these time frames and take most signals off of that particular time frame you choose. But before you do that, you have to be aware that higher time frames are always going to have more influence on price than lower time frames. So monthly is stronger than weekly, which is stronger than daily, which is stronger than 4 hour, etc. And you're going to get more noise the lower you go. So the lower you go, you will get more signals and opportunities, but you also get more noise, and you're prone to being influenced by the higher time frames. So intraday price action can get knocked around a lot by short-term news, order flow, and you're more or less a flea on the back of a gorilla. Whereas higher time frames, they're more influenced by psychology, sentiment, and fundamentals, which we feel are factors that are easier to measure and analyze. That's why we prefer the higher time frames. So you can see in this example, this is the S&P 500 E-mini futures. Here's an hourly chart. It's pretty erratic, and then you can run into huge freight trains of news that completely distort the charts and the price action. On the daily chart, you're a little less susceptible to the huge fake out moves, but we see that they still come up a little bit, and the chart is still a little noisy. It's very difficult to clearly define the trends here. Whereas we back out on the weekly, now we get much more clarity. So the trends are clear, the consolidation zones are clear, and it's just a little bit easier to tell what's going on in the chart. And then finally, monthly, the clarity improves again. And then quarterly, we have the most amount of clarity. So we focus on weekly charts, and we feel like that gives us a nice blend of clarity and the amount of signals per year. So if you're trading quarterly bars, you're barely going to be able to trade per year. And if you're trading 4-hour bars, you're likely to be lost in the noise and overtrade, etc., and get chopped up. So we like the weekly time frame. We feel like that's a good blend of what we're looking for. And specifically, we're trying to identify patterns made up of 8 weekly bars or more, because as markets consolidate longer, they're more likely to trend. And this filter helps keep us from A, over trading, and B, also try to enter into decently sized trends. And then finally, we use pretty strict pattern definition to help avoid decision fatigue. So when we go into the charts on the weekly, we don't fall prey to Rorschach analysis. We're pretty strict, and we like to see something that pops out at us immediately after looking at the chart. So here are additional cases for trading higher time frames, and not everyone's going to trade higher time frames. Some people do enjoy taking a lot of signals and battling in the noisy lower time frames, but here's the reasons why we like the higher time frames. So number one, it protects against noise. We know that you're not susceptible to getting jostled around. It's going to help prevent impulsive decision making, because the candles only print, say, every day or every week or every month instead of every 5 minutes. So you're less susceptible to making an impulsive decision. And then it preserves emotional capital, because you're just not looking at your account as much, you're not looking at the markets as much, and that can create a lot of stress and anxiety if you're constantly looking at the charts and trying to fight the tape, and also watching your P&L tick up and down day after day after day, minute after minute after minute in the lower time frames. So this all plays into the more conducive to a healthier lifestyle concept and prevents what we call blue collar despair. So for us, we don't like to sit and watch the markets every single day for 8 hours, watch every little tick go up and down, which you would have to do if you're trading the lower time frames. We'd rather spend our time doing more analysis and be able to think a little bit deeper than that. So that's why we like the higher time frames. And it's also a definite emotional save for us, because in investing, you're your own worst enemy when it comes to staying emotionally stable. And the more you look at your account, the more you tend to kind of get knocked off the rocker and enter that emotional downward spiral. So that's why we like higher time frames, and we feel like they're much easier and much less stress to trade. Now, the last concept I want to talk about in this lecture is nested patterns. So, and this is an advanced concept, but due to the fractal nature of markets, we can actually go down to smaller time frames and enter smaller patterns as a means of getting into a larger time frame pattern. And this is called nested patterns. And basically what happens is a small little pattern will form in the market as a launch into a larger pattern. And what we can get is the tight risk from the smaller pattern and then the potential reward from the larger pattern. So let me go through a few examples. It's easier to show this rather than explain it. And so you can see here on crude oil, this larger falling wedge that ended up creating an uptrend could have been entered by a nested double bottoming pattern. So on the weekly time frame, you could look at this as the primary move coming out of here from the falling wedge, but then you can enter it if you see something smaller within it. So this is a perfect example of a nested time frame. You could see on the daily here, we had the false breakdown that ended up creating a double bottom, and you could have entered on the breakout of that double bottom and get a better risk reward entry into the ultimate trend. Here's another example on soy oil. So we can see this is a larger head and shoulders bottoming pattern, and you could have used this falling wedge here to enter and get a lower price with a better defined risk reward that hopefully runs up higher and breaks the larger pattern's neckline. And then finally, we got this example from soybean meal. So on the weekly chart, we had this huge falling wedge that broke out and ran hard, but you could have entered it near all the way at the bottom of the wedge if you were able to spot the nested complex head and shoulders bottom. So on the daily chart, we could see a nice little basing consolidation, a complex head and shoulders, and you could have entered it right here and had a really, really nice risk reward on the eventual move. So let's just measure this one real quick. You entered it off this daily pattern. Let's drag the stop up inside the consolidation area. And here's the target. You could have had a 13.35 risk to reward ratio on this particular trade. So 13x your risk, just because you entered off a smaller pattern into a larger pattern. So this is the power of nested patterns. It's a more advanced concept, but keep on the lookout for them because they can be an extremely lucrative way to take a small amount of risk to enter a potentially huge trend.